Hello, everyone. Welcome to this month's live market update. My name is John Pasalis. If this is your first time, welcome. My team and I help buyers and sellers throughout the GTA make better real estate decisions. Of course, if you're looking at making your own decisions, would like to meet with me and my team, you can just click the link in the show notes below. But we always host these. I host these once a month with our team. Gus and Davin are on the call as well. Mortgage broker David Larock, to give everyone an insight into what's going on the ground. A lot of times it is a little bit different than what you read in the press. And that's what this is about. And as always, Urmi Desai, our editor, is on, and she'll be looking at your questions. So if you have any questions, feel free to post them in the chat, and we'll kind of answer those as well as we go along. So as always, I'm going to be looking at the latest stats for houses, the latest stats for condos. We're going to look a little bit of a closer look at the condo market. And we're going to be bringing on Gus and Davin to chat a little bit about some of the on-the-ground trends, and David Larock, as always, as well. Now, before I kind of jump in and talk about housing stats, I thought I would change things up and talk a little bit about cars. And there's a reason I'm going to chat a little bit about cars. I actually saw someone on Twitter who's a housing analyst kind of use a car dealership analogy when talking about the balance in the housing market. And I thought it was a really good one. And I thought I kind of, because we're going to be talking a little bit about these dynamics between sales, which is demand, new listings, which is kind of the inventory coming on, and then the active inventory. And the idea is, if you think about a car dealership, if the car dealership has 100 cars coming into the lot every month, and they're selling 100, then their inventory is going to be constant. But if they got 100 coming in and only 50 cars are being bought, well, their inventory is going to start to build up. And similarly, if they got 100 cars coming in and 120 are being bought, well, in a few months, you're going to see their inventory drastically reduce. And I think this is kind of one of the things we're going to be chatting about today, this relationship between sales, the relationship between new listings, and active listings or active inventory. So we're going to take a quick look at the market for condominiums first. For houses first. And when we look at the number of sales for detached homes, sales in July were largely, very close to a 20-year low. The 2 years that were actually lower were in 2022 and 2023. And so we're looking at a very, very sluggish market in terms of sales. And again, I think a lot of this, of course, is affordability. People can't afford to buy homes. If we look at sales volumes, for example, detached homes in July were very close to 2,500. More typical sales volumes would be, between 3 and 3,500 is average. In really peak years, we'd have 4,500. So around 2,500 is really soft sales volumes for detached homes. When we look at the number of new listings for detached homes, they are, I'd say, in line with historical trends, close to 7,000 new listings of detached homes. It's pretty typical. The previous 2 years were a lot lower, but nothing out of the ordinary. But when we look at the number of active listings, again, those are higher than last year because we've seen more new listings hit the market, and demand hasn't picked up. So new listings are higher than they were last year. And similarly, because the volume of listings is sort of outpacing the sales, what we have is the months of inventory increasing. And the months of inventory is just the number of homes available for sale divided by the number of homes that sell every month. And the idea is, how long would it take all of the current inventory to sell if nothing else hit the market? And we're hitting 4 months of inventory for low-rise homes right now. It's roughly where we were a year ago. Last summer was quite slow. And if we look at months of inventory, it does this up and down depending on the momentum of the market. And again, it's largely driven by these imbalances between supply, demand, and sales and new listings. So right now we're seeing a relatively sluggish market. What the fall will look like will, of course, depend on the volume of new listings and sales. And we look at average prices. Again, we're just over 1.3 million for a low-rise home, which is down slightly over last year, but not a huge decline. When we look at the condo market, slightly different dynamics, and we talked about this. So condos also have really soft sales volumes. Not quite very close to 20-year lows. The last 2 years actually were lower. Actually, no, last year was a little bit higher. And 2022 was actually lower than this year. So we look at July sales volumes, about 1,500 condos sold. Typically, we're closer to 2,000. So this is really soft volume, very similar to what we would have seen about 20 years ago. But when we look at new listings volumes, I mean, new listings are close to a record high. The peak for the month of July was actually in 2020. So we're just over that, about 5,300 new listings, give or take, for the month of July. A more typical July would be something in the range of mid to high 3,000. So we have a lot of new listings. And again, part of this is investors exiting the market. It's one of the things I've been talking about recently, kind of in the press, that some investors just don't want to keep carrying their units. If they're cash flow negative, if they've had to refinance or renew their mortgage at today's higher rates, they just don't want to keep holding it. So we're seeing an increase in the number of investors exiting the market, but the demand is pretty soft, and we're not seeing a lot of investors enter. And what this is causing is a record number of condominiums on the market for sale for the month of July. This is just condo apartments alone, and we have 9,000 or so of them. More typical for the month of July would be anywhere from 5,000 to 6,000. So again, a record volume of condominium apartments for sale in the GTA. And this is causing the month of inventory to surge to just roughly 6 months of inventory now. We're a little bit above it now that we're in August. But again, very soft. We're kind of well into buyer's markets territory. But even though we're in buyer's market territory, prices have been pretty stable. I mean, prices for condominiums are, again, down slightly year over year, but we haven't seen this significant dip. If we look back to 2022, when the Bank of Canada started hiking rates, we see that was kind of the peak of the market. Average condo prices were in the low 800s, around 830 or something like that. They've since come down quite a bit, and we haven't seen that type of a sharp decline yet. And the question is, will we? I think it's anyone's guess. We'll take a look at what the fall numbers look like. And before I kind of jump into the condo numbers and some of the things to keep in mind when we go into the fall market, I'm going to take a look at sort of the weekly months of inventory. It's something I often look at because this gives us a more timely look at what's going on in the market. And again, as I mentioned, if you just look at this, and the way you calculate weekly, I mean, it's not, we don't just look at weekly stats. We basically look at how many active listings are on the market right now, how many have sold in the past 30 days. So the time series is a little bit more timely, and it's relevant in periods when the market's changing a bit, and we want to keep an eye on those dynamics. And of course, inventory has been accelerating.
Stress that email from Mom. Apparently, you've got an appointment.
Now, if we look at the condo market, a couple of things I'm going to kind of quickly look at for those of you who I did a video on this just very briefly on YouTube earlier this week, but I'm just going to touch on it quickly for those who haven't had a chance to see that, and for our, of course, podcast listeners. Now, the key thing to think about when we think about the condo market is I wanted to look at a longer time series to look at how these trends have evolved, both sales, new listings, and active listings. and take a look at how things have changed. Now, to get rid of, in the previous charts, I'm just looking at those numbers for the month of July to account for these seasonal differences. But I don't want to just look at July. I just want to look at the whole time period, like over the past, say, 10 plus years. To do that, to get rid of these peaks and valleys during the slow months versus the high months, what I've done is taken what's called a 12-month moving average, which basically says, for the month of July, we're going to look at, if we're looking at sales, we're looking at the average number of sales over the previous 12 months. And we're using that for July's numbers. And then, of course, for August, we move everything up 1 month and just look at the previous 12 months for the month of August, and so on and so forth. So this smooths out the trends. We don't see all these sharp changes, but it gives us a better idea of some of the longer term dynamics. So when we look at sales volumes for condominiums, when we look at active listings, I should say, active listings have been trending up. In 2022, we had about 4,000 active listings on the market at any given time. We're now close to 8,000. This is the highest sort of on trend that we're looking at. In 2013, 2014, we'd have around 7,000. So now we're at 8. This is, again, trending up. Now, when we think about what's driving this, a lot of this is the decline in sales. When we look at sales, again, on an average 12-month basis, we are at quite the lows, at least in this chart, 10, 12-year lows, with roughly 2,000 condos selling in any given month. A more typical period would be, a more typical volume would be 25, 26, 2,700. In the peak, we'd have 3,500 condos selling per month. So sales are soft. And because sales are soft, this is one of the big reasons inventory is building. New listings have also been increasing, but they're not as far out of the ordinary when compared to sales volumes. I mean, new listings have been picking up. We're slightly above where we were in 21, 22, a bit above where we were in 2015, but it is the sales that has kind of really contributed to the increase, I'd say, in the listings volumes. Now, when we think about where the market's going to go in the fall, it's very hard to say. If active listings continues to pick up, in theory, we probably might see some downward pressure on prices. But again, it's going to depend on what demand is like and what listings volumes are like. Many of our clients are basically coming to us and saying, if I don't get X price, maybe we should just take it off the market and rent it instead. And so we need to keep an eye on what is going on with rental listings. And when we look at the number of new listings for rentals, those are actually increasing at a faster rate than condominiums for sale. So leases on average, we have, over the past 12 months, monthly, we'd have about 7,000 new listings of condos for rent versus about 5,000 listings of condos for sale. Again, they're not comparable because the turnover for rentals is a lot higher. But the point is there's a lot of investors still sticking around, even though we have some exiting, some are sticking around, holding their units, stubborn on prices. So these dynamics will be key to watch out for when we think about how the market evolves over the next 3-4 months. And I do think the fall market's going to kind of give us a lot of signals, because this is when, and David's going to be joining us shortly, we might see some rate cuts. How does that feed into the market? But of course, a lot of economic stress as things are cooling down, because if we get a lot of rate cuts, it's because things aren't going very well economically. So on that note, I'm going to stop sharing my screen actually and invite kind of Gus and Davin from our team to join me to talk about some of the trends that they are seeing on the ground in the market.
Hello.
Gents, thanks for joining.
Hello. For having us.
Yeah. So maybe Davin, I see you there. Why don't you kind of kick things off, maybe unpack some of the things that you're seeing on the ground now with the clients that you're working with?
Sure. Well, as everyone knows, condo market's slow, so we're not gonna beat that dead horse. What I do have is people who are entering the freehold market, and it's kind of surprising that the volume at which it's sort of taking place. It's been pretty quiet the last 3, even 4 months. And then, the phone starts ringing and emails start coming in just in the last maybe 3 weeks. And people who want to buy, they see what interest rates are doing. Even if they don't keep going down, they're happy at where they are for the most part. And and it's just sort of a precursor of what might be to come. I'm not saying, oh my gosh, it's like going to be on fire, but the people are starting to kind of get out there, and these are folks who are reasonably high net worth, CPAs, execs, even some people in the C-suite, and they want to get ahead of what they feel might be a competitive market going forward. Listings are still low. I'm sure Gus can speak to listings coming up. If they're going to match each other, we'll kind of see. But I think we're gonna start seeing the market really pick up in the freehold space for sure, and maybe some more condos might get starting snapped up. But like I said last time I was here, maybe 2 months ago, the swamp of listings. There's just a lot of bad condo listings out there. So I think those probably still remain tough to sell. But ones that are do have some marketability are probably going to get snapped up a little bit quicker. But I'm not lighting any fires right now. So
yeah, and you touched on a couple of important things I think that are worth noting. That a lot of the times, and a lot of people I guess don't see this or maybe don't appreciate this much, but there's generally two cycles in the housing market. It's people who kind of jump in and start looking in September, and people who jump in and start looking in the spring market, let's say, which would start as early as January, February. And the reality is we often see or get a sense of what the fall market and spring market are going to look like ahead of time. In our office, if, as Davin said, our phone's not ringing, we're not getting emails from new clients in June, July, August, it's going to be a very slow September. And I tend to agree with you. I mean, we've been getting a lot of requests online. I've been getting some personally. It looks like things might pick up a little bit. Certainly for houses, hard to say for condos still. I don't have as good of a sense for that, but definitely we're seeing more buyers and new buyers kind of jumping in. So it's interesting you kind of point that out. Gus, what are you anything you've been seeing recently?
Yeah, kind of same thing. I mean, when you think back to last year, specifically August is a month that I point to where you can kind of gauge August and December. Those are months where you can kind of gauge what because for those that maybe are new to the real estate cycle, it picks up in January with the January, February, March with the spring market. I know it's not spring, but we get a lot of buyers contacting us those months. And then again, for the fall market, we get buyers kind of starting out to search in September, and they contact us again the month before. Last year, August was just crickets. And I remember like, oh my God, there's like nobody around. Whereas this year, Davin's right. I'm seeing the same thing. A few more phone calls. Definitely people who I feel like there's been, and I think I've said this the last few months, there's been a lot of people on the sidelines kind of watching. I've been communicating with a lot of different people who are interested in entering the market, but the language is we're not in a hurry. We're not looking to jump. We'll take our time. It's got to be the right home. We have choice now. And that's been the case throughout this year and this month for the most part. With in terms of Davin's comment with inventory, I agree that there isn't any quality inventory in specific high demand neighborhoods. There is inventory in good neighborhoods. You got to look. You gotta overlook certain aspects. It might not be the perfect home. It might be a bit of a fixer upper, but there is some value out there, and I'm seeing a lot of homes, and I think the data, John can speak to this, but a lot of homes that are selling under asking, and the bidding wars are very rare. And there's just a few neighborhoods that are really sought after, close to transit, closer to downtown, that certain homes are selling quickly, but even those they're not getting many multiple offers. So there's just not a lot of really good quality. A lot of fixer uppers are sitting, that's for sure.
Yeah, and on the bidding wars, Urmi, I think we got a question about properties priced below asking and bidding wars in our chat.
We do. Charlie asks, seeing some increased pace of sales in Vaughan and the Maple area in my neighborhood, agents pricing below market to get multiple offers and end up at or above market within 2 weeks of listing.
Yeah, interesting. So what's happening here, to Gus's point, is, I mean, some agents are I mean, they're pricing homes like it was April, not like it's August, quite frankly. And they're pricing way below market value, expecting to get multiple offers. They don't. And when they don't, they have to increase the price. We've talked about this on the show. I think it's, to me, this is like mispricing, quite frankly. Like if you're pricing below market value to get a certain price, and listen, sometimes there's an element of luck, I'll say that, but like you have to be extremely confident that the type of home you have doesn't have a lot of competition and is going to actually get multiple offers on the offer night. Otherwise, you just end up wasting a week or week and a half on the market and relisting. And certainly, I mean, I've seen a ton of that. I don't know if you guys have seen some of that. A lot of agents just increasing their price because they don't sell and then just end up sitting on the market.
Yeah, I'm seeing plenty of, a missed offer night at, let's say, 1.199, and they just leave the price there at 1.199, and that price isn't even on the menu, and it sits there for 30 days. And that's, to us, like we know that's 99% of the time not the sticker price, but it's probably very frustrating to the general public to see this home that looks like it's for 1.2, but in reality they're never taking that and they need 1.45 or more. And it's
a terrible tactic. We talked about this. To me, it's very it's misleading. So like Davin's talking about, they list it for 1.2, they really want 1.45, they get no offers on the offer night, but rather than relist it for a price they want, they just leave it at 1.2. But if you bring them 1.2, they'll say, no, we want 250 over asking. And again, it's just so odd, and you're right. They'll be on the market for 30 days at 1.2 without a sale because they want 250 over asking. It's very, from a marketing perspective, it's very confusing. It's misleading. Anyhow, yeah, it's very odd when realtors do that. And I'm going to blame the realtors, quite frankly, because there is an element of educating your client. At the end of the day, our clients ultimately decide what to do, but like we really try to get them to avoid doing stupid things, and then that, quite frankly, is a pretty stupid thing.
Well, yeah, they call it it's a marketing price. I'm like, okay, that's just your name. But imagine doing that anywhere else on the whole planet. You walk into the grocery store and it's like, oh my gosh, like my loaf of bread is 84 cents. Great. You bring it up to the front, like, no, we want 350. Like
it is. And listen, to be fair, some people might say, okay, how's that different from the bidding wars when people list them? And all I'll say is the difference is that when a property is listed like that, there is an offer date. Yeah. It is very clear that it is an auction. So yes, when agents sometimes price low, there's a method to it, but at least it is transparent that there is a scheduled offer date, that they're anticipating getting multiple offers. It's very different from just listing at a certain price and waiting a month at a price that you don't really want.
I guess might be getting into the weeds, but I really feel like there should be, in the public domain, what you see in listings, there should be a space where you put in if there's an offer date or not and what that date actually is.
But that's a good point, actually.
A button on the MLS that says, I'm listing it as auction. How about that? Yeah. Imagine you're looking through listings and you see auction on the listing versus we're taking offers anytime. And that's super easy, right? For everybody to look at and say, oh, okay, they're holding back offers on this one. It's got an auction button, right?
Yeah, I really think that they should put that on the MLS because, a lot of people see some prices, they think they can get it, it's in their budget, they don't realize it's going to sell 20% over the list price. So yeah, I think some transparency would be.
It may or may not. Some people list with an offer date at the value. Like it's really just the discussion between the seller and the agent what they want to do. There's no hard and fast rule. You list X amount below, but that's the job of the realtor to ascertain the value. But it just sort of eliminates the case where people think there's a sub $1 million house that they're just like no shot. So if they just had that little thing to select, that would probably be beneficial to many, but I'm sure you'd get lots of realtors saying boo about it. So it's probably never going to happen.
Yeah, 100%. Urmi, did we have any other questions, I guess, for...
Oh, Urmi's on mute.
I'm on mute. Yeah, sorry. We do. From Fran, there's a question. Would you please give us an update on sale by commission structures? There has been talk of changes of commission structures. What is the current commission rate and structure? Thanks.
Interesting question. So I think Fran's probably been looking at changes in the US market, which might be coming down the line. And really, it's not that different from what we do here for the most part. I mean, there is no standard commission rate, quite frankly. You can get anything in every range. I mean, if you went on Reddit and asked if a realtor would list your home for $2,000, I'm probably sure you'd find someone who desperate who would do it. In Canada, you can list your home on the MLS for a flat fee. You don't necessarily have to have an agent representing you. On the flip side, you have agent, like most agents charging what is used to be the traditional 5%, which is 2.5% to both agents, usually are paying for staging, paying for painting, doing all these additional things. This idea that someone's charging 5% and just putting a for sale sign up, I mean, is very old school. I don't think that's happening very much. So at the end of the day, I think, sellers still have a ton of options when it comes to negotiating. And you'll see so many different things that realtors will do, from very low fee, very low service to very high fee, high service. And I think it's any range. And I don't know if you guys had anything else to add on that.
Well, I think the biggest part of the thing in NAR down in the States was the cooperating commission being offered. It wasn't so much what people are charging to do, perform the service. It was more they were setting kind of a standard for what is being offered to the cooperating brokerage,
which is the buying brokerage.
And I mean, if you go to, for example, Burlington, the standard there, if you will, not that there is one, but that seems to be across the board, is 2%. In Toronto, it is 2.5. It might be 2.25. It might even be 2. And the argument is, you want to keep every eyeball that you can on the property by offering what everyone else is sort of offering. There are some agents out there who will just try not to show the 2% offering homes, which I think is crazy. 2% is more than ample for pretty much every house in Toronto. So I think that's more what the discussion is as far as, I don't know, anti-compete down on.
Yeah. And 100%, I think that's fair. And I do think a lot of that was more about bringing transparency to what buyer agents get and having buyers have more flexibility in negotiating that. I say that's similar because I think that's been going on here. Like a lot of buyers still negotiate what their agent's going to get. And if their agent gets X%, maybe they kick back something to the buyer. So that's been going on here. But I think what they want to do in the US is just not have it advertised what the seller's paying the buyer agent, or, just changing those structures. I don't know if that's going to come here, but it'll be interesting to see how that plays out in the US. Awesome, guys. Anything else to kind of add to that, or any other stories?
Yeah, I guess I do have one, just to kind of speak to, logistics of a sale.
Yeah.
Only because we haven't really had a, team meeting in a couple of months because somebody was in Greece. Anyway, so had clients who sold in the Toronto area, nice neighborhood. And, as we always talk about, the discussion was, buy first or sell first. In short, if you buy first, you can find the home you want. You got to be pretty confident about your home sale. Worst case, you put yourself in a very, bad financial position. And of course, for sell first, you kind of know what your proceeds are, know what you can spend. Worst case, you put yourself in a very inconvenient situation of finding a rental. So the case for sell first got really great when these folks actually sold. Now, we had a pretty good idea of what we're going to sell for, but we sold for about 85, almost 100K more than what we really expected. Just had well-marketed property, lots of good conversation with agents, got multi-offers. And this is in like late June. So this is not a hot time at all. And it ended up that they could get their proceeds. And instead of us looking in like Newmarket, Aurora, they were able to actually stay in the hood they wanted in Toronto, moving from a 2-bedroom to a 3-bedroom, about probably less than half a kilometer away. So
That's interesting. So
Yeah,
they thought
we
thought they're so they thought they were going to be priced out of buying in Toronto, but because they got say 80 or 100 grand more than what they expected, they're able to stay in the neighborhood.
Yeah, because we looked in Toronto and we were kind of like, like we are just on the cusp of being able to buy something that is, decent. But I mean, when you're towing the line, it gets really close to think you want to spend X, but you only might receive Y.
Yeah.
Whereas they were able to really, make a choice that kept them in the place they want. So usually we say if you sell first, like that keeps the financially precarious position away. But in this case, like another good argument is like you might be able to just you don't have to like underbuy a house. Not that that's like a bad thing, but that was their worry. Like they said, oh my gosh, we didn't have to like underbuy some dumpy house, say in Toronto. They could actually get what they wanted and stay in the space they want. Like same school, same daycare, same dance school, the whole gambit. So
yeah, that's actually a very interesting scenario because I mean, and we talked about this on the show where, and like, I mean, at least the way we advise our clients is if they are buying first, they need to have a conservative budget when it comes to selling. You know what I mean? Like, not expecting the best, not needing to sell at a certain price because, like, I mean, I've seen cases where people buy their list, and then I've talked to agents. I mean, other agents, their property's listed for 1.3, and they're like, the seller needs to sell, but they have to sell for the list price, otherwise they can't close on the home they just bought. I mean, that's a terrible position to be in.
Yeah.
So so it's an interesting story because the flip side is you're right. If you end up getting a little bit more than what you planned, you have more options. And maybe in a market where in markets like this where things are slow, you want to have some certainty on your sale, and there is a decent amount of inventory to choose from as a buyer. If there are in the neighborhoods they're considering, that could be a decent strategy. And I think it goes back to, again, we talked about this idea of buying, selling first. I think is about the market, about the home you're selling, about the home you're buying, your risk tolerance. It's like all of these things combined. So that's an interesting story.
It's a nerve-wracking time to be an agent that needs to help a client buy and sell.
Yeah, buy, sell.
Wow. Yeah, you really have to narrow it down to looking at, is the neighborhood the same that they're buying in? Is it less competitive, more competitive, and really play defense if they are going to buy first and sell second in terms of, do you have a backup plan in case you can't sell? And yeah, can you be ready to take a lot less and budget for that? And if you do get what you want or more, it's icing on the cake. But yeah, I think I already have. I've recommended to many. Maybe it's a good time to sell first, and we go in and buy into the fall, especially going into this winter fall season. I can't imagine buying in October or November and then having to sell in December. Even though I think the fall might be a little bit busier, it's probably going to be a sluggish, late November, December for sure, more so than other years.
Yeah. I met with clients late last night who are in the same position. They're looking at upsizing. And in their situation, what they want to find is kind of hard. They don't know if it's going to take 4 months or 9 months.
Yeah.
And at least in today's market, that even though it's slow, the type of home they have in the area that they have tends to sell quickly, right? So, they're leaning towards buying first. But even in their case, I said, listen, this is not an absolute decision because we always have to keep revisiting this. And especially like once they find the home they're looking at buying, you don't just go in and make an offer. You almost have to like hit pause and say, okay, wait a second, what's going on in the market for the home that they need to sell, right? And then before you make that commitment, reevaluate your decision, because a lot of people don't do that, and they realize they commit to buying, and then when they go to list, they realize there's 4 other homes just like theirs on the market that aren't selling, and then you're in a bind. So you constantly have to be, I mean, kind of worried about these decisions. You know what I mean? It's not like you decide now and it's the same decision for 9 months. So yeah, very good points, guys. Guys, thank you so much for joining again this month and for sharing some of your stories. We're gonna have Mr. David Larock kind of jump on, mortgage broker extraordinaire, who shares his columns with us on Move Smartly every week. Thank you, David, for joining us.
Good to be here.
Yeah, so let's just kick things off with I feel like a lot has changed since and it's remarkable. Like, honestly, in a month, I feel like so much has changed economically, both in the US, expectations about rate cuts in the US, expectations about rate cuts in Canada, economic trends in both. So maybe if you can just the 10,000 foot view of like what has changed and kind of evolved over the past 30 days and kind of where we're at now.
Yeah, well, John, I've been writing for some time that I thought the Canadian and the US economies were going to slow by more than expected, and that the warnings from the BOC that Canadians should expect that rates aren't going to fall that quickly were about as useful as the comment that Governor Macklem made back in 2020 that Canadians could count on rates not going very high. And I've written the same about the U.S. In the U.S. right now, people don't know this, but Canadians have saved some of their pandemic savings. They've burned through a lot of it. It helped them absorb higher prices. It's the reason the economy looks stronger for longer, because people were burning through savings. In the U.S., Americans burnt through all their pandemic savings, and they're burning through more of their savings. And the U.S. savings rate is the lowest it's been in a very long time. And the U.S. federal government is actually outspending the Canadian federal government, which, again, is not intuitive to most people. That isn't usually the case, but it's been the case now for the past couple of years. So the U.S. economy is also, I've been writing for some time, due for some reckoning. So what's happened since last we spoke? The Bank of Canada cut again. And this time around, the bank adopted very dovish language. It basically, all of the messaging was around further rate cuts should be expected, provided inflation doesn't do a 180. Of course, they have to say that because their mandate is to preserve price stability. So inflation might prevent them from doing what they want to do, but all else being equal, the BOC is ready to cut. And that makes sense. Right now, the BOC's policy rate is at 4.5%. A neutral position by the bank's own estimate, where its policy rate is not restricting growth in the economy nor stimulating it. They estimate, and it's a theoretical construct, and they tell you not to put too much into the numbers, but lots of economists agree with their assessment that a neutral policy rate is somewhere between 2.5 and 3. So if the BOC is at 4.5, the economy's weakening, everything is slowing. Whether we get a recession or not, typically, when the economy slows, the Bank of Canada has to take its foot all the way off the brake. Right now, it's relieving the pressure on the brake, but it's still hitting the brake. So now the question is, well, when is the BOC going to actually take its foot off the brake? When is it going to get back to neutral? And the timing on when that's going to happen has moved around a lot. At the beginning of the year, people thought it was going to happen quickly. Then the inflation data didn't cooperate. The BOC toughened up on its language. And the bond futures market dialed back the bets on what the BOC would do. But now it's gone the other way. And sure enough, here we are. The BOC is now expected to continue cutting by 0.25% at each of its remaining 3 meetings this year and into next year. And that's consistent with what I've been forecasting. Again, don't always get it right, but I ended up being right on this one. I think the market now expects the BOC to cut by about 1.5% more, no later than by the end of next year. And I think now we may get a 0.5 point cut by the BOC at one of its remaining 3 meetings this year. And I wrote in my most recent post, that'll be because of average wages. Basically, wage growth has averaged 5% plus, and that's been the thorn in the BOC's side. They basically said 5% wage growth and falling productivity aren't consistent with achieving our inflation target. And that has been kind of the offset that's prevented the bank from cutting by more. And when you look at base effects, long story short, I talked about this a while back when it comes to inflation. There's 2 things that change the average wage data each month. We add a month. So next time we get the wage data, we'll get it in early September, and it'll be for the month of August. We will add the average wage data is calculated looking back over the most recent 12 months. So in September, we'll add whatever the wage growth was this month, but we'll also drop last August out of the data set. last August, wages were growing like crazy. So when they fall out of the data set, we had 70 basis points of month-over-month growth. To give you an idea, so far this year, we've averaged 22 basis points of month-over-month growth. So we're gonna, and over the last 3 months, we've added 19 basis points of month-over-month wage growth. I know I'm getting technical here, but the long and short is, if we assume we add 22 basis points of month-over-month growth in September, and we lose 70 basis points of month-over-month growth on the back end because it falls out of the data set, that's going to bring average wages down. So all else being equal, and we're in a slowing economy now where all bets are that wage growth is going to slow more. But if it just maintains where it's at, average wage growth is going to dip below 5% next month for the first time in over a year. The following month, it gets really interesting because last October, wages grew by 161 basis points. So the following month, we're going to lose month-over-month growth of 161 basis points. And again, if we get 22 basis points on the front end, like we've been averaging, average wage growth is going to fall into the high 3% range. If that happens, and you're the BOC saying wage growth is a big concern for us, and the bond market, so far, I'm not reading a lot about these base effects and the impact they're going to have. That's really going to impact where the market sees rates going. And I think bond yields will fall, and I think that'll open up the door for the BOC to cut by more. But also, John, if we continue to get that 22 basis point growth by December, wage growth will be under 2%. It'll be below the Bank of Canada's target rate for inflation by December, which isn't that far away. And if that happens, then we're in a different rate environment at that point. Then the BOC is looking full bore at slowing economy, more pessimistic business expectations, more pessimistic consumer expectations, falling inflation, lower investment rates, retail sales continuing to fall. All of these things then become the focus, and the BOC doesn't have to keep talking about wage growth being too high. In the US, and this has really moved because Government of Canada bond yields, which are what our fixed rates, our mortgage rates are priced on, follow their US Fed equivalents. In the US, the expectation is that the Fed is going to cut by 0.75% by this December. So in its last 3 meetings of the year, and that it may cut by 50 basis points when it next meets on September 4th. And that's what pushed bond yields down a couple of weeks ago. And that's the reason why fixed mortgage rates have been falling. So we have tailwinds when it comes to mortgage rates on both sides of the 49th parallel. We've got a more dovish sounding Fed, softening US data. We just got the latest US inflation print this week. It came out yesterday. And it was a little below expectations. So certainly nothing there to cause people to recalibrate because inflation was higher than expected. That was really the thing we were watching for. And sure enough, it confirmed that inflation was a little cooler than expected. And when it comes to Canada, the BOC is already quite dovish. It's already cut twice. The question is not, are we getting more cuts? The question is, how fast are the additional cuts going to come? And where's the bottom? And the bottom is probably 2.5% to 3%. And most mainstream economists think that we'll get most of the cuts in by the end of next December. It takes about an average of 15 months from when rate cuts start. So that's consistent over the past 5 rate cut cycles, 15 months. That would be more than 15 months. And I think rate cuts are more urgent this time. So even if we just assume they follow the average pace that they've followed over the last 5 rate cycles, we're fine by next December. And again, if you're taking a variable rate today, you're still paying a premium. You're probably looking at about a 1% premium over what you pay for a fixed rate. But if you believe that variable rates are going to fall quickly, and if they drop by another 1.5% from here, then it's worth that premium. And again, that's no crystal ball stuff, John. My opinion, $2 is only ever guaranteed to get you a hot cup of coffee, but I watch this stuff very closely. And I do think that I think we're in a falling rate environment. I think a lot of the obstacles to more urgency around rate cuts are being removed as we speak. The big one will be average wage growth. And you heard it here first. In the next couple of months, it's going to start dropping. And when the market really starts pricing that in, I think that means lower rates ahead.
Yeah, that's wild. I mean, as I said, when we kind of started this little segment with you, it's remarkable. I think maybe it was 2 months ago, 2.5. It's like the narrative at the time was rates will stay higher for longer. We might get 2 cuts this year, right? We've had 2, and we're expecting 3 more now. And possibly 1 in January. So remarkable, obviously, change. But again, this is all driven by a weak economy, right? So, and again, no one has a crystal ball, but I'm kind of curious to hear your thoughts on this relationship between, obviously, in theory, lower rates stimulate demand for housing, but on the flip side, you have weaker economic conditions, people losing jobs, people hearing about friends losing jobs, not being able to find one. What do you think or anticipate the effects are going to be on the housing market over the next 3-4 months, taking both things into, because obviously one seems bullish for housing, but obviously the economic conditions are not. So what do you think we can expect going forward?
Well, it's a great question, John. And I think what's interesting is we're in a different environment now. The last 2 times that rates really dropped, we were lucky because we got the benefit of the lower rates, but our housing markets and our economy weren't that impacted. First example, when the US financial crisis happened in 2008, US Treasuries fell through the floor. Government of Canada bond yields, which our fixed mortgage rates are priced on, follow US Treasuries. So they got pulled way lower. But we didn't have a financial crisis in Canada in 2008. At the time, our economy was lauded as being one of the best managed, and our financial system was robust, and people were saying our banks were the best run in the world, and we were getting all kinds of praise. So we got these crazy low mortgage rates, but we didn't have the thing that was causing them, which was the US housing crisis and the financial meltdown stemming from the US. So in that scenario, if you were paying attention back then, if people aren't new first-time buyers and they were paying attention, because that was 16 years ago now, gosh, that's a long time ago.
Yeah.
Then it was true, rates went down, housing market rallied. So there you got the proof. Then during COVID, same thing. Rates went through the floor, but the economy stayed strong, housing market rallied. So once again, low rates equal strong housing market. Anybody paying attention at that time would draw that conclusion. This time around, rates are low, but the economy is weakening. And this is a very different backdrop than those scenarios. So while it's true looking back that when rates went down, the housing market rallied, I'm not so sure this time. I've been warning people, that narrative doesn't always work. And if rates are falling because the economy is weak and people are worried about jobs and income, it's not a time when people run out and get in bidding wars to buy houses. So this time around, I think ultimately the housing market should stabilize. Aside from some new construction condos, and I think there's risk there. We've talked about that. I think overall the housing market should stabilize, but I don't think we should be surprised if the market goes down a little bit. And interestingly, John, in the Bank of Canada's last monetary policy report, which they issued a few weeks ago at their last policy statement meeting, they actually now, it's funny, not long ago, they were worried that rate cuts might stimulate speculation in the real estate market. That was their theme for over a year now. They were saying that was one of the reasons why they were cautious about when they wanted to start cutting rates. Now, not only are they no longer worried about lower rates causing speculative activity in the real estate markets, in their forecasts and projections, they're actually now projecting a robust recovery in real estate. So people say, well, if the real estate market goes nuts, is that going to change their BOC's plans? And I say, no, the BOC right now is hoping for that. And when they're justifying their forecast, which is that we're not going to hit recession and the economy is going to be able to sort of struggle along, part of that is part of what's underpinning that are some pretty aggressive assumptions about a robust recovery in real estate. So the BOC has gone from worrying that low rates would cause real estate bubbles to now counting on a real estate recovery in order to bolster the economy, which otherwise needs it because it's slowing. And
interesting.
I'm not convinced that we'll get that, but
did they have a timeline for when they think the housing market would sort of rebound?
Well, in their monetary policy report, they forecast out for 3 years, and they're. I can look it up real quick while we're chatting, but
don't worry about it.
Their absolute projections are optimistic growth, and I think they're expecting a pretty realistic I think I think they're expecting a pretty robust rebound in 2025. So I don't think they're projecting out,
Too far. Interesting.
2 years here. This is next year stuff.
Interesting. Yeah, I mean, it'll be interesting, obviously. And I agree with you. I don't know if the fall market is going to be overly bullish. I mean, I think we might see a little bit uptick in sales, but I agree with you. I mean, I think 2025 is going to be kind of the one, obviously, that we're going to have to keep an eye on. Obviously, it depends on where the economy is going to be and obviously the relationship with rates and kind of demand, because obviously once we hit 2025, I'm going to be in a very different, we're going to be probably in the low fours for interest rates, which is going to be very different, or high threes even, which is obviously going to be fundamentally different from the mid fives which we've been used to the past couple of years. So interesting times. Urmi, I don't know if there's any questions, or if you have any questions before we kind of wrap things up.
Sorry, I have gremlins in my computer today. I don't see any more questions. Actually, I think that was a very thorough overview from Dave. Discussing this seemingly switch around. So the link to Dave's latest posts are in our show notes, and to John's latest report as well.
Awesome. Beautiful. Yeah, David, thank you so much for that, for the background. Obviously, always get your insights. I mean, nobody reads all of these economic reports as thoroughly as you do. So I think all of us on this show have the benefit of reading your great work and obviously getting your insights every month, because I mean, like I said, you're reading not just the Bank of Canada stuff, you're reading everything, I feel. So really have a finger on the pulse of what's going on in the macro trend. So thank you again for joining us this month.
My pleasure. Thanks for having me.
Yeah, and thank you all for joining us and for your questions. I hope everyone has a great end to their summer, and we will see everyone again in mid-September. We'll talk to you then.